everyone for coming today. Delighted to bring you this one of our finance focus sessions. It was interesting as I was talking about this. Obviously, community bonds are something I was saying to Pauline. I'm really interested to hear more about kind of what the community bond approach is all about. I've read little bits, but not heard you speak about it, Pauline. So I always say these sessions are really helpful for me actually to get a sense of what's going on. And we really, I guess, wanted to frame this. We've got this session coming up, and I think we've got one coming up in a few weeks around Bitcoin, because I think there's lots that's going on that's quite innovative around finance all the time. And I think, you know, people are kind of certainly used to the grant funding approach. I've run various sessions myself on loan finance, and I know you've perhaps been involved in bits around that too. So, you know, we're always seeing these kind of new ways for organisations to look at income generation and raise finance for them to basically do what their organisation set out to do. So I'm really looking forward to hearing you talk about community bonds. I know you've got a case study that you're going to talk us through. And as ever, I would encourage everyone, do use the chat if you've got any questions. Pauline is the person that knows about this stuff, so it's your chance to really ask any questions, and we'll be coming to the Q&A at the end. We'll try and do it a bit like a conversation as well, Pauline, once you've given us a general intro. So feel free, anyone, to pop in with any questions in the chat and Q&A. So I'll hand straight over to you, Pauline, just to introduce us to today's topic.
Okay, I'm just going to call up this just to make sure that it works. So that's the screen. That's it, yeah. Okay, everybody, so my name is Pauline Hinchion, and I'm going to be talking to you today about community bonds. I suppose, first of all, thanks to Naomi for the introduction, and also I think thanks to Social Enterprise Scotland for hosting the event. I said thanks to you for coming along, because I know that, you know, finance can be seen as being quite a dry subject, and certainly yeah, so if you're taking the time to come along, it must mean that you're interested in it. I also have an apology, because I was supposed to be doing this. It was supposed to be a double act today with Neil Barnes from Linlith-Go Community Development Trust, because they are the case study that we're going to talk about. But unfortunately, Neil was called into a work meeting at very short notice. So I am going to try and be Neil as well as be Pauline. But really, as Naomi said, you know, I know myself, I don't want you to be listening to my voice for the next 45, 50 minutes. So I would really appreciate if people could kind of ask questions, queries, comments. You know, there's no right or wrong answers, but anything that you might want to say, even if it hasn't to do with community bonds, might have to do with finance generally. I think everybody on this webinar are here because we're interested in finance. So please do feel free to, at the end of this very, very brief slideshow and case study, then perhaps we can have a more general discussion. Okay, so I'll move on.
Thanks, Pauline. You might want to put it on the slideshow format. That'd be brilliant.
Slideshow, yeah. Set up slideshow. Where is? Oh, from beginning, right? Okay, that's it. And I think it's been a while since I did this, so I think it's just move on with your next. Yeah. Okay. So just one slide about Scottish Communities Finance. So we are a Community Benefit Society, and we are registered with the FCA, and we only started in October 2017. And which meant that COVID has really knocked us off course in terms of the progress we wanted to make today, but we have made quite a bit of progress, so I'll be talking through some of that. And predominantly we work with social and community finances who wanted to raise affordable, patient, repayable monies, basically. So what are community bonds? They are predominantly a vehicle for securing repayable finance. So they're not charity bonds, they're not corporate bonds, they're not government bonds. There are no secondary markets for community bonds. The investor exit is a fixed maturity date. And you'll understand that maybe a bit more, and I'll talk a bit more when I go through the case study. So I'm hoping a lot of these points will come up at the case study, and therefore you'll be able to take the the words that I'm giving you and the bullet points I'm giving you and see how we apply them in real life. Investors have no ownership or governance responsibilities. The whole system of community bonds is very much part of a democratic finance landscape. And that means that you are mining the interest of your community or your customer base, and you're offering them the opportunity to become your investors. So what we do is we work with organizations, legal entities, and we encourage what we call ordinary people, not necessarily high net worth individuals, but maybe people who could be your customer, maybe people who are in your community, to encourage them to become investors. And we call these people citizen investors. And it's meant to recapture the fact that they're people who are interested in supporting social and economic and environmental activities. So a lot of the time it's offering people micro investment opportunities. So, we've had, bond offers starting at 50 quid, 100 quid, so anybody can theoretically actually buy a bond. Obviously, people can buy 10 or 20 just as well. There are investor financial returns. So it's important to recognize that this is not a donation, it's not a grant, it's not a philanthropy. The expectation is that people will get their money back plus a financial return. And the whole idea of that is that if they get it back, then they might reinvest it again. Because unlike a donation, which is a one-off, this is as much about retaining money within the community, local people using their money to reinvest and invest in their local community and activities in their community. And that's community of interest as well as community of place. Community
Pauline,
bond,
sorry to interrupt, Pauline, someone just said you were a bit quiet. So if you're able to speak up a bit, that would be fabulous. That's okay.
Can you hear me better now? Oh, hold on. Maybe this is down low. Hold on.
Thank you.
That better?
Yes, that's a little louder. Thank you.
This must have turned. Apologies, anybody. So if you want to come back and ask me any of those questions, or if you want me to go back to that slide or this slide, then I will happily do that again. So the thing about community bonds is that they are very user-friendly, and they can be used for asset purchase as well as non-asset based finance. If you were to come to SCF and we work with you as a partner, then if you don't have a BENCOM, you use our BENCOM. So you don't have to actually establish your own if you don't already have one. There's no minimum threshold in terms of how much you raise. I mean, if, we've had situations whereby people have only wanted to raise 17,000, and we're in the middle of doing a potential bond offer hopefully by Christmas, which is a £2 million bond offer. So, we don't prescribe that. That is purely, it's what you need to do what you want to do. It's not about us saying we don't deal with that kind of money. It's too small or it's too big or whatever. Although I imagine if we're getting beyond 2 million, it probably is too big for us and we'd be referring you to somebody else. And basically the way we operate is that we then get a fee once the money is raised, and the fee is payable on a sliding scale. So the smaller raises we tend not to charge. The larger ones we tend to go on a percentage, and really it's just to cover the cost of actually doing the bond, because there is a lot of costs associated with the bond, preparing the bond, developing the bond. Sometimes we have to get paper copies of it. We have websites. There's quite a lot of costs involved with all of that. So really, but we do recognize that some of the smaller ones, it might be too onerous. So we don't charge anything for that. And that's because we get some money from the Scottish Government. So that's really the slides about community bonds. And I'm now going to talk to you about the case study. And that's really to, I suppose, to bring all of those points to life a little bit. So essentially, this is a case study around an urban solar project, and it was Linlith-Go Community Development Trust, and they were interested. They had a history of doing solar renewables in the town, but they were predominantly in receipt of grant income to carry that out. They wanted to expand that and look at local sports facilities in the town, and they struggled to get some grant funding for that. And that's where they started looking at other forms of investing. So just to give you a bit of background about Linlith-Go and the reason that they chose solar is actually because they have something like 1,299 hours of sunshine a year, which is much higher than the Scottish average. And the Development Trust themselves, very much about making the town carbon neutral, very much about doing climate change stuff, so transition Linlith-Go. They also have a cycle circuit. So the whole idea of actually looking at energy was really was part of their history, but also they were interested in a model that might bring in some money to them. Now, you'll all be familiar that there are, you know, communities, particularly in the north of Scotland and in the more rural areas, where they've put up wind turbines in order to generate income to do stuff in the communities. It's much more difficult to do that in an urban community because obviously there's issues about planning and space. And so Linlith-Go Community Development looked at doing solar. And they set up a project called Linlith-Go-Solar. And Linlith-Go-Solar, as I said, they started off, I think they ended up putting putting solar panels on 400 houses in the local area. And then I think they started getting some interest from some of the local sports clubs. So they were looking for finance. They ruled out community shares, and actually it was DTAS that referred them to us. They ruled out community shares because they didn't want to set up a community benefit society. They already had a scale, but also because they really weren't interested in growing their membership. They had quite a robust membership. So all they really wanted was money. All they really wanted was investment. They didn't want any of the others. So DTAS actually then referred them to us. And so we sat down and we had a chat with them and we thought, okay, maybe this is something that we could be doing together. But it was decided that we would begin on a pilot basis. And that was just one club. And to see how the community bonds model worked, to see how the installation worked on the club, but also they were trying out what is called a power purchase agreement, which is a PPA, which would see the LCDT actually become the energy supplier to the club. And that was really important because actually once the money was paid off, then LCDT got all the revenue from the club once the money was paid off. So in a couple of years' time, all that money would be coming in, and therefore it met its obligation of actually setting up a fund that they could do good within the community. So they moved into this and they approached us, and you know, there is a process that we had to go through, and part of that process was us looking at, was this a viable model? Did they have the ability to repay? So a lot of due diligence around some of that, a lot of due diligence around the costing and the modeling, particularly the modeling around the rates of interest we could repay. And that's really important when it comes to energy, because since the feed-in tariffs are no longer available, the affordability of these schemes is really important. And part of that affordability is obviously how much you pay for your money. So we were looking at that, but also the stuff we were looking at is what kind of maturity dates do we want to set for the project? And the Linlith-Go were very clear, the Development Trust were very clear, they needed a period of patient capital to allow the roof, the solar panels to be installed, but also to allow the income to start coming through. So we set out basically three exit dates, three maturity dates for investors, 5, 8, and 11 years. So quite patient money. We incentivized the more patient. So if you stayed in for 11 years, you actually got more than if you came in for 5 years. And the rates of interest that we're talking about were very low, 0.85% for 1 year, or sorry, for 5 years, 1.15% for 8 years, and 1.75% for 11 years. Now that is very low because interest rates are very low at the moment, but it was still better than what people were getting at the bank, still better than what they were getting ISAs. So we still had a quite attractive proposition, but the organization were getting money at a very affordable price, which, as I say, is really important when you don't have the feed-in tariffs. So we did, like all democratic finance, we determined who the community was, and we decided the community was members of the club plus the wider community. And so that's who we actually targeted when it came to the community bond. You do what you would normally do in democratic finance. You reach out to them. There's a period, there's an opening period, there's a closing period, and there's a bond prospectus or a bond offer. And basically we raised the money fairly easily within the time scale. So we closed early. They got the money, and the solar panels went on the roof, and that's a picture of the solar panels on the roof on the screen. As a result of that, actually, they were approached and they started conversations with other sports clubs, because it was recognized that the pilot worked well, the community bonds worked well, and actually the PPA worked well. And that project now, which has been going for 3 years, you know, is well on target to meet its investor repayable interest and capital. So then phase 2 started. So we did a second community bond offer with them, which of course you can do. And again, went through the same process because it was a larger community bond offer. It involved more roofs, it involved more technology because it involved battery storage as well for the second one. And again, we did the same thing. We went out to the community, again, agreed that it was going to be 5, 8, and 11 years interest. And again, we actually made the target earlier than we anticipated. So again, we closed it early, and that project was completed literally the week before COVID in 2019. So the next stage for Linlith-Go is potentially quite a large community bond offer, potentially a solar array, because communities seem to like it. And I've just actually, just to summarize this project, so I've just completed a survey monkey with the Linlith-Go-Solar investors, both sets of investors. And it was really interesting. Something like 60% of them who were invested in state in the first pilot came into the second pilot. What was interesting is the rates of return was not, nobody thought the rate of return was particularly low or that turned them off. But as I say, we're in a low interest environment anyway. And there's some really interesting findings coming out of that in relation to the fact that people wanted to invest in energy, and also the fact that they wanted to invest in their community. So that really is the case study that I'm hoping will trigger some questions and maybe reinforce some of the bullet points that I brought up earlier on. And that's it, basically. That's my presentation. So thank you for listening. Hopefully it was interesting, and I'm looking forward to hearing all of your comments or queries or questions.
Thank you, Pauline. A few questions have come in, just some of it about just points of clarification, just because obviously there's lots of terminology, and I think we're both used to have, when you're used to this framework, you drop things in and you don't always realise. So I've been doing a bit of acronym busting in the background, and but there's just a couple of questions. One was people just obviously BenComs are quite new to some people. So I just wondered if you could say a little bit about BenComs.
Okay, so BenComs is short for Community Benefit Societies. Community Benefit Societies are relatively new, but they're built on what used to be known as the Industrial Providence Societies, and they're predominantly a cooperative approach to business development and how you might set up your businesses. But the Industrial Providence Societies, which had been set up in the 19th century, and by the mid-20th century, perhaps they weren't fit for purpose. So we started seeing the emergence and the changing of the IPSs to become community benefit societies. And in 2014, I think it was, there was Community Benefit Society Act. And that really is very much about a cooperative approach to developing businesses as a model, the same as the old IPS used to be, which is Industrial Providence Societies. So this is very much about trying to do good, I suppose, in terms of whether it's social and environmental, economic good within the business model, and giving members a voice in that model. So the predominant community benefit society model is probably cooperatives, but there are other ones like community shares, community bonds, and I'm sure there are other ones out there as well.
Thank you, Pauline. And certainly, I mean, we've run sessions in the past with Community Shares Scotland, because it's one of the structures to use community shares. You either have to be a BENCOM or a cooperative. So I would say if people wanted to know a bit more about that, look back in our old recordings as well, and you'll find out much more about that community shares model as well. So it's helpful, but there's so many legal structures, as you know, in our sector, that I think people are often surprised to come across another one, but it seems to be like that, I think, sometimes. And I just wondered if you could just another phrase that dropped in was just patient capital. So if you could just say a little bit about what you mean when you talk about patient capital, and then I'll go into some of my other questions.
So those of us that have a mortgage or a credit card or a car licensing agreement or whatever, we all borrow money, and then on a certain period each month we have to pay it back. So we pay a percentage of it back. So your mortgage is a certain date, your leasing comes out, your lease of your car or your credit card, you have to pay certain sums of money every month. The point about patient capital is that you don't really pay anything until you're at a certain point in your development. So because what is the point? Let's just take an example, because I've been speaking to a theatre group. What's the point in asking them to start repaying a loan 1 month after opening, if they only have 5% capacity and they can't afford to repay the loan? So there's a patient period. So that could be, for example, when they have reached 70% capacity, then they will start repaying the loan because they're getting the income in at that stage. Or it could be, for example, when you've reached a certain threshold of trading in terms of income, that might trigger the beginning of the repayment of the loan. So it's actually a period where, and it can be both, it can be both an interest-free period, a capital-free period, or it can be both. And in this case of community bonds, it's both. So that gives the organization time to put the solar panels on the roof, start regenerating income before they're actually expected to start repaying the loan, as against month one, week one, you have to repay the loan and you've nobody in your restaurant, or you've only got 5 people in the restaurant.
No, thank you, Pauline. I mean, it's a term I know I've used quite a lot when I've done work around social investment, and it tends to get used a lot, but I think it's helpful to people. I always think patient is about patience from the person that's needing the money back. So very much about that setup. There's other questions that have just come in, and I might pick up on those, and then just some more general questions. So a very specific one, just in terms of looking at the case study you talked about. How much did Linlith-Go raise in phase 1 through the bonds, and also how much did they raise in their second phase?
In the first phase, it was very small. It was £17,000. So that's what I was saying about the minimum. And I think in the second one, I think it was 50 odd thousand.
It's interesting because I guess I see that pattern come through sometimes when people use loan finance or other things. They almost get their confidence with a type of finance structure and then think, actually, that worked for us. We could do something else, or we could do a bit more. So it's interesting to see how perhaps second time round it was a bit more.
What was obvious to us, and when we did the second time round, is that once the solar panels went on the roof club, and there was obviously lots of local publicity because we engaged the media and all that kind of stuff, it's like people suddenly, investors got confidence. They kind of thought, oh, well, they actually are doing this. So the confidence is on both sides. It's on the side of the organization who'd never taken loan finance before, and also on the side of the investors who kind of, once they saw the benefit, or once they saw that they were actually doing what they said they were doing, we found it much easier to do the second one.
Yeah, no, that's really interesting. I hadn't thought about it from that investor perspective as well, but absolutely, it's obvious when you say it. I just wondered, in terms of, because it was one of my questions as you were talking, again, having heard kind of the Community Share Scotland team talk, they almost, when they're looking for investors, almost produce a kind of a brochure or something that outlines kind of, I guess, said that people are clear in terms of what the rates of return might be. Do people going down the community bond approach how do they raise or find their investors? And do you have to go down that process of producing a document and getting all of that clear?
Well, you do actually, because we are registered with the FCA, and you do have to produce a prospectus or an offer document. And again, and a lot of that offer document will have, your money's at risk. If you're looking for a weekly return, you're not going to get it. you know, if you should take advice if you have any concern, independent legal and financial advice. But essentially, it is about making the offer very clear and transparent. It's also an opportunity to highlight the social outcomes as well as the financial outcomes, because I think community bonds are perhaps 60% social and 40% financial, because I know people who invest could, if they wanted to go to the market, get higher rates of return. But actually, we are restricted in terms of we cannot prioritize investor returns. We have to prioritize the sustainability of the organization and the community that we work with. So the bond document, it can be, FCA is very, they're very proportionate around this. So for the £17,000 one, for example, I think it was like 10, 12 pages. It was available online. It was in the library if you wanted to pick one up. The whiskey one is a much more comprehensive one because it's got a lot more. We're looking for 2.2 million, so it's a much bigger sum of money. And that's going to potentially be about 50, 60 pages, lots of financial information in there. So really, but you have to produce something. You don't have to produce in paper form. That's your decision as to whether you want to put one through people's, you know, leave one at the library or the council offices or whatever, but you certainly have to make people aware that it's available online. And this is the work that we work with in partnership with the organization. We put it online, but when an individual, because you can apply for community bonds as an individual as well as an organization, and lots of businesses do, they apply online, the application comes directly into us. And we have an escrow account, and that kind of is a specific account where we hold the money on behalf of investors until the closing date, and then we hand it over. And equally, when it comes to the repaying them, we get paid the money and then we pay the investors. So there's a separation between, you know, you as the organization raising the money and your community or your customer base, where the wall between, so you will never know who invested or who didn't. And that's really just, if things did go wrong, and we're lucky things haven't gone wrong so far, it's early days, but nothing's going wrong. You know, you don't want Mr. Smith to put a brick through your window because he's lost his 50 quid or his 100 quid or whatever. The other aspect of it that's really important is that, that it's not to say we don't get high net worth in individuals interested, but what we're careful to do is not skew the balance in terms of undue influence on the way the organization operates, because even though there's no ownership issues, the reality of the matter is, if you know you've put 50% of the money, perhaps you might feel you're entitled to be heard. Whereas we feel it's really important. I would prefer we had 600 people putting in £100 each, and maybe one or two high nets putting in relatively, to balance that kind of sense of influence, if I could use that. Does that make sense?
No, it's interesting because, again, knowing a bit about the kind of community shares model, which is the obvious one, I think, to compare this to. Obviously, yes. At that point, the thing about the community benefit societies, people have to become members, and then it's what you get a vote. If you put money in, you get a vote on what happens within the organisation. And albeit it doesn't matter how much you put in, it's if you put £10 or £1 million, you still only get one vote, but you still get that right in the kind of way that the organisation runs. So this obviously is the big difference, I think, between the shares model and the community bonds model.
Yes, there is, in theory, because there's no membership and no ownership. But the reality is, you can imagine a small customer base or a community of interest you can imagine how somebody, if they had a sense that actually I've kind of put a lot of money into this, you know, I want to be heard. And actually that I worry sometimes that can then skew perhaps the initial idea. So I prefer to focus on the democratic form of the finance, in the sense of I would for lots of people to be part of it, lots of people and actually the research that's coming out as well from the survey shows that actually people, once they become investors, their interest in what you're doing increases exponentially. So they do kind of, maybe if it's your customer base, maybe they will come back knowing that they're more likely to get their money back if people come and buy more, and they might buy more. Equally in the case of the community as well, as suddenly they're kind of more interested in what the organization is doing, which can be a good thing for them in terms of actually, people saying, oh, love what you're doing, can I come along to view it or to see the roofs or whatever the case may be, whereas previously they might not even have been aware of the organization that exists in that community.
Yeah, no, it's really interesting, because I think again, some of the rationale for getting your community to buy in is also that sense of it's about creating that link with social purpose and the and the area you work in. So it's really important. I'm just going to pick up just on before we went live, we were kind of chatting, and I think I was saying, often sometimes whether you're preparing for like a large bit of grant investment or loan investment, there's often steps you can take before you might apply. So are there any kind of ways that if organisations were looking at this, maybe not for right now, but for the future, that they should look to prepare?
I think, yeah, listen, I mean, this isn't something that happens overnight. I mean, the bigger one we're doing at the moment, I think we've been working on it for 8 months, because, and even the Linlith-Go one, which was the first stage, we were working on it because, we have to sign MOUs, we have to agree what each of the partners are going to do, we have to do the due diligence, we have to work out who the communities are, we have to work out the interest rates, we have to work out the business proposal, we have to look at the ability to repay. So, it's a constant engagement much, much earlier than you would think before the bonds go live or the offer goes live. People seem to think that's the start of it, but in a way that's the end of many, many months of getting the website organized, getting the bond perspective spot on in terms of what you wanted to say, distilling down the social outcomes, all of that stuff. So I suppose, yeah, like in one sense, it's like any other form of, investment or repayable finance. You do need to do the work beforehand. You need to decide, maybe, often we will have a discussion and we might have 2 or 3 discussions with the organization, and they might decide community bonds enough for them. That's fine. As you say, Naomi, there's so many different models out there of actually getting money, and I would prefer that organizations actually got what was useful for them and suitable, rather than you have to take this type of money. It may be that this isn't suitable, for example, if you're looking for a very short-term loan. It's very suitable if you need a lot of time before you need to start repaying, as we've already discussed. So I think, yeah, there's a lot of work needs to go into it beforehand. You need to understand that, have you got the ability to repay? And also, I think, recognize that the ability to repay will inform how much interest you can actually offer. And that can be an issue, because if somebody else is offering, something similar, say solar, and they're offering 4% return, and you might only be able to offer 1.5%, we would not encourage you to go for 4%. As I say, we have to prioritize the needs of the community and the needs of the organization. We cannot prioritize the needs of the investors. And this is where I think you are looking at then trying to genuinely engage social investors, because they might be getting slightly less than they get somewhere else, maybe if they went onto the stock market, or maybe if they went somewhere else to invest their money. But actually, you're really trying to say, look at the wonderful stuff that's going to come because of that. So you might be getting a percentage less, but you're getting so much more in terms of your community. And I think community bonds allow that to happen. But the one, just to be clear as well, so the one we're going to be doing, the whiskey one, that's only one maturity date. It's a 10-year maturity date. So it's not about offering lots of, it just depends on what needs to happen and when you have the ability to repay, and also, how far in advance you need things to, how far you need to allow yourself the time to build up enough money to repay. And the other interesting thing about the 3 different maturity dates as well, it means that not 100% of people want their money back at the same day. 30% might want back in the 5 years, 10% might want it back in the 8 years, and the balance. So again, you're spreading out your ability to repay the loan.
Yeah, no, really helpful, because one of my questions was going to be who's this not suitable for? So, the bits I'm hearing is obviously it's repayable finance. So if you haven't got a way of earning income, then this isn't
Yes.
suitable for you. And I guess as you were talking then, I just picked up on the kind of, it's probably more suitable to longer term finance than short term loans. So that's quite helpful for people. There is a question in my chat that's just more general about banking, and I'm going to come to that at the end, Liz. I haven't forgotten or missed it, but just so that we finish off on the questions around kind of community bonds first. I just wanted to ask, obviously, I know you presented the case study on behalf of the organisation. I know when I've spoken to people in the past about kind of taking on loan finance, often the big barrier can be kind of maybe the board of directors being nervous about this, and sometimes the staff think it's the right way to go and the board are perhaps more hesitant. I just wondered, what do you think the experience was of your case study organisations? Is this coming from employees? Is it coming from the board? And were there any challenges in terms of getting other people over the line as they looked at doing this?
Well, that's a really important point. Actually, I'm glad you brought that up, Naomi, because I should really have brought it up. So initially, it's like all of these things. There was a board member who was particularly passionate about this. And that's the person who was originally referred to me and we met with. But one of the things I'm very conscious of that is that because this is repayable finance, the whole board have to recognize what they're taking on. It can't be just, oh, Neil is really interested, let him just do that. Because if anything goes wrong, everybody, it's the whole organization. And so, I did meet, and I still meet with boards. I like to see all of them. And I explain, you are taking on a loan. And often, I mean, in 2 cases, they walked away from that as a board, but that's fine, as I say, because sometimes a staff member or a particular trustee or 1 or 2 can run away, and the boards they see it as their pet project and they don't take the interest that they need to. So I insist on meeting the board. So when I was down in the borders, for example, I met the board 3 times because I wanted to be convinced that they understood what they were taking on and they weren't just saying, oh, this is Mick over here, he loves doing all that kind of stuff. And then if anything went wrong, suddenly they go, oh, we knew nothing about that. So there is that aspect to it that I think is really important. But I have to admit, in the case of the case study, I did speak to them 3 times, which gives you an idea of perhaps it wasn't like once and then they were like, right, okay, let's go for it. They had more questions and I had to go and see them again. And given this was prior to COVID, I used to actually go in person. But eventually, they got it. They got it. And actually, having done the first one, the second one was a cinch. They kind of understood, they'd seen the money coming in, they were a lot less concerned about it. And basically, so there wasn't the same degree of discussion as there was them taking that first foray into taking a loan.
Thank you. I think that's really helpful because, again, governance is really important to any type of community, or well, any type of business actually, but particularly I think community organisations, that sense of good governance and having all the board. We talk about having the board on board.
Yeah.
So I think it's really interesting that you kind of really pick up on that being across everybody and making sure it's not a pet project is really important. So that was really helpful. I'm just going to ask a couple of last questions and then I'll come to just the general one. And obviously you touched a little bit on interest rates and they are low in terms of the repayable. Do you see that would change over time? Obviously, if interest rates shoot up, we've got obviously budget announcements today. So, or do you set those, and obviously then because of the sense of the length of the project, it's fine for this company, but maybe people who come in the future, if interest rates are higher, will that affect what people are able to offer?
I have to admit, you're right in the sense that anybody who's thinking of taking out a loan right now, whether it's community bonds or another form of particularly democratic finance, because you're kind of cutting out the middlemen, you're going directly to your investors, then there's no doubt that now is a good time because you can make very attractive offers because the interest rates are very low. But we do know inflation is creeping up. We know that pay rates will be creeping up, and we know that bills are creeping up. energy bills and, you know, other kind of bills. And so that will probably impact on inflation. However, in spite of that, and it is a fine balance, in spite of that, you really have to sit down and say, at the end of the day, you can offer anything you want. You can offer 10%. But if that means in 2 years' time, that project is going to collapse under the weight of that, you have to go back to what you can afford, what the project or the activity can afford to actually pay. And if it is lower than what's out there at the moment, as I say, it's very easy to beat what people are getting in the bank. I mean, you're getting 0.02% or something ridiculous like this from the bank. But if that got a bit more competitive, then it does come down to really, really selling the social outcomes, trying to explain why you can't give the same as, another who's doing, carbon polluting stuff. It really is about coming down to that. Yeah, so it's a really important question. There's a lot of thought goes into it, in terms of how long do you really, because obviously for organizations, the cheaper they pay off their debt, the better for themselves, so it's not about dragging it out in perpetuity, but equally, it's about making sure that the interest rates are right. It's about making sure that, when the first maturity date kicks in, because that's the exit strategy, then you have the money. And there's a lot of thought and a lot of time looking at the modeling of that.
Yeah, it's very much aligned, I guess, with a full business plan. Ultimately, it's not which has to be a longer term thing. I think that comes back to your point about it being a longer term approach, not just a short term bit of finance. So very much really important to get your head around that.
You have the bond offer, and obviously the level of detail in terms of finances that goes in will be included, but not everything. So if you have got a full business plan, if you've got a full set of projections, then they're also available. They mightn't be in the bond offer, but they will be on the page that, that says everything about what's going on and shows the lovely pictures of all the stuff you're doing and all that kind of stuff. And also we keep up to date with we manage the investor role. So, we will do periodic, maybe quarterly, half yearly, reports. Oh, this what happened this week, your money paid to do that, and look what the wonderful thing that. So there's all the time you're constantly engaging them in the social outcome, because they're waiting a wee while before they get any financial return. So you're trying to keep them interested in the social stuff.
Thank you, Pauline. Really helpful. I mean, it's always hard. I think, like you say, you met boards 3 times and there were still questions. So I know in kind of 45 minutes, an hour today, it's quite hard to answer all the questions on community bonds. So I'm just going to encourage people, if they've got any last questions, to just put those in the chat. And we'll wait and see if any come in. I'm just going to ask, this probably is a slight aside to community bonds, because I like to be helpful to anyone that's on the webinar, and you will have seen a question come in just generally about banking for community interest companies, and someone's just saying they're having trouble opening a bank account as a KIC. And I just wondered, we will have some other KICs on our session today. I'm always wary of kind of that whole product placement, and the other providers are around, but there's obviously a number of banks that I know we've worked with that talk about kind of supporting social enterprise. And I just wanted to ask if any of our other attendees on today's session are KICs. If you are willing and comfortable to just post in the chat who you bank with, that would be really helpful to one of our other participants. And I'll happily pick up on that question. And I actually wonder whether maybe a webinar in the future just on that early stage finance for people very new at setting up an organisation would be worthwhile doing. But we've certainly in the past, organisations like Triodos are certainly, those kind of social banks tend to be quite well orientated and very familiar with our sector. But my experience is more mainstream banks are getting more familiar with the kind of KIC terminology now. Pauline, have you come across other KICs having challenges, or?
I can't say I have, actually. I'm surprised at this question, because we I must admit, I haven't heard for a while people having problems setting up a bank account. I do know, for example, recently that traders have stopped opening bank accounts. Now, I don't know, that tends to be, the charity bank, the traders bank, they tend to be the banks, Unity Bank, they tend to be the ones we use. But so I don't know what's going on there, and whether that's indicative of a wider issue in terms of banks just not opening any kind, like it's not about legal structure, it's just about they're not opening bank accounts, or whether it's specific to Triodos or it's specific to. But I actually have to admit I haven't heard anything about KICs having problems opening bank accounts. Be interested to know why that is the case, actually, because they're a fairly recognized model now.
Yeah, no, I was surprised, but like I say, I like to kind of help people when there's challenges and questions that they've come across. And we've had Unity on actually running sessions with us in the past as well. So I can perhaps send you the link to the recording of our session with Unity as well. And we'll pick up on that, and I can see some people have been helpful in the chat. Sometimes other enterprises can say things that in terms of experience and who they use that tells it how it is, that I would be more cautious of in terms of just giving a very balanced perspective. So thank you for that slight diversion. I haven't seen any other just questions come in on the community bonds issue, Pauline. So I just wondered if people were interested and they want to find out more to take this further, how do they best contact you? What's the first step that they should take? And we'll perhaps finish on that as a kind of closing question for today in terms of understanding next steps for people.
Okay, so basically it would be really helpful if I'd put a website and a phone number and an email on something, wouldn't it? But actually, if you just go to the website, Scottish Communities Finance Limited, our contact details are there, and they'll show you some case studies, what a community benefit society is, frequently asked questions by investors and also by organizations. So there's quite a lot on there in terms of general community bonds. If somebody wants to have something specific, then they can certainly come back to me. They can email me at Pauline@ScotCom Finance. That's one SCOTCOM FIN. So it's just the first couple of letters from our name, or alternative, just go onto the website and email us. But broadly, I've just been looking through the chat because I haven't had the time up to now. So apologies, I believe the purple was quite difficult for you to see. I use purple because it's kind of our brand color, but maybe in future I will only use black. And also I think it looks like my mic was on quiet for quite some time. So again, apologies for that. I hadn't realized that at some stage I had actually lowered the mic. So by all means, I believe Naomi will make the presentation available afterwards. So you can certainly, and please feel free, make contact. And basically, if there's even anything in the bulletins or the presentations that you missed or you weren't sure of, happy to kind of get back in contact and explain them again.
No, great, Pauline. I was going to suggest if you wanted to just put your contact details in a slide and send me over the presentation, then what I can do is I can send out a copy of the presentation with your contact details in it, which I think would be really helpful for people.
Yeah, that's a great idea. And I'm going to also put in the number.
Brilliant. And I can see you've got your email address in there. So yeah, thank you. And I guess that last comment just to close from someone saying actually sometimes looking at things like loan finance for some organisations can be quite daunting for people. So even just to listen in and be at the start of some of these conversations has been helpful. So thank you for joining us today. It's great. It's been helpful. And I'm also putting a note to myself on maybe us running a session in the future at SES on just more general introduction to finance for new starts that could be helpful. So always really helpful when people put their questions in because it stimulates us looking at future topics. So thank you very much, Pauline. Really pleased you're able to join us. And it's helpful for me to know a bit more about what community bonds are as well. Just when we signposting, it's always good for us to know more.
They are relatively new. They're relatively new. I'm not, in Scotland, they're relatively new in the UK. So, and as I say, COVID kind of knocked us off trajectory. So this is us kind of in a way, restarting practically again in terms of, so I understand that, you know, there will be questions and people might queries, and as I said, I'm quite happy to answer, and it won't be for everybody, you know, but if, and I'm quite happy as well to say that to people, maybe this isn't the best model for you, or maybe, or for them to say to me, you know, we've looked at it and we've decided, no, even if we've had a number of meetings, that's what it's all about, is you getting the right type of money to meet what you need at the right time, at the right price.
Absolutely, absolutely. I couldn't agree more. Ruling things out in or out is really valuable for people. So
yes,
thank you so much. I'll leave the session just open in case anyone's just noting down your contacts just for a couple of minutes, and then I'll close down today's session. But thank you so much for joining us, Pauline, and it was great to see you.
Yes, you too.
Yeah,
it's been too long. This is what COVID does.
I know, it's small. Well, it's widened our world in many ways, because we see lots of people, but it's just all through a screen, which is quite strange.
It doesn't feel the same, does it? But listen, thank you, Naomi. I thought you shared that really well, and you presented, and I really appreciate you capturing all the chats and stuff, because actually I just didn't have time to read them. So thank you.
Brilliant. Thank you, Pauline. Have a good day.
Take care.
Have a good day, everyone.
Bye, everyone. Thank you for attending. Bye.
Bye.